Thanks for tuning into BQ Conversations. I'm your host, Neeraj Shah. This week, we are trying to talk to some of the marquee fund managers in India to try and understand the kind of changes or the churn that they've done in their portfolios over the last 12 months to prepare their portfolios for the next 12 to 24 odd months, and try and understand from them why is it that they would have done some of the moves that they have made, and what is the context for the portfolio being what it is at the current point of time. Our guest today to start off this series of conversations is Trideep Bhattacharya of Edelweiss AMC. He heads their equity piece. And Trideep, it's a pleasure having you today.
Good afternoon, everyone. Thank you very much for inviting to your show. As always, a pleasure to be on your show.
Thank you so much. So viewers, remember, some of you might be individual investors into some of those schemes, and the individual characteristics might be different. Maybe from an overall perspective, what we try and talk to Trideep Bhattacharya today is the overall equity positioning of Edelweiss AMC. Trideep, has there been a significant change in the portfolio from what it may have been, say, in the composite period of the first half of 2022, or maybe even dating back to the second half of 2021?
Yeah, I think there are two or three things that come to mind when you ask that question. First of all, I think the portfolios have gotten a little more concentrated than what we were earlier. It is more got to do with placing the bets where the conviction lies, and kind of sizing up the bets relative to what they are. Second, the portfolios have been aligned to the themes that we are particularly positive on. And the themes that we are positive on include basically industrials, stroke capital goods, financials, direct and indirect plays on real estate, and also country specific or very idiosyncratic themes like defense, indigenization of defense, China plus one, etc. I'm sure you'll quiz me on some of these later, but just as a starting comment, those are the areas where we have consciously populated the portfolio towards and pruned down some of the smaller holdings so that we can put more conviction behind wherever bets are.
Can I ask you about the nature of this concentration? For example, I mean, when you say that you upped the concentration a bit, what would typically have been an allocation to a theme, or in a large cap fund, maybe a stock, but let's assume a theme. What would have typically been the maximum allocation? And if you've upped it, what has it gone up to, so to say?
Basically, I think when I meant that earlier we had somewhere around 75 to 80 stock portfolio about a year or so ago. We have now moved on to somewhere between 65 to 70. And so to that extent, the portfolio concentration has gone up, not just in one, but across different portfolios, some more than that of others. And the reason why we did that was more with regards to, as we kind of went through the year, we got more convinced or more convincing evidence about the themes that I mentioned. And as we did that, we got, we looked to consolidate our positions, as I was saying, to show more conviction in the themes that we have. So we haven't particularly allocated theme-wise percentage, but overall, some of the 50 basis points, some of the smaller positions, we have suddenly exited and moved towards places where we felt more conviction.
Got it. So, Trideep, I heard you mention about some of the themes, but I'd like to start off with some bit of research that we did about, and we chose three of your schemes, which is the large cap, the flexi cap, and the small cap, to get a sense of what you would have done across the spectrum. And please correct me if I'm wrong, of course, into any of these, but let me try and ask you. So, for example, let's start with financials. We saw that financials, which was, of course, the heavyweight sector, your allocation has gone up significantly from what it would have been in November 2021, maybe slightly lower than August 2022, but almost at par. And even in the small cap end, interestingly, in the small cap fund, that allocation has gone up significantly, which means you found financial options or options in the financial space, BFSI space, not just amongst the large banks, but the smaller BFSI names as well. Tell us a bit about this.
Absolutely. And I think that's a good spot. As always, I told you before the show as well that I love being on your show because of the research that you do before you entering the show. But I think that's a good spot. Somewhere towards the first quarter of this year, we realized that if we look at valuation support and if we look at where the credit growth is bottoming out, we saw a clear signal that the credit growth was bottoming out somewhere around September, October last year, and we thought that cyclically the banks have seen a lot of bad blood go through that, and hence from that perspective, have a good time of growth ahead. Putting these fundamentals as well as valuation picture together, we went significantly overweight on financials as a starting point. First of all, in the large cap banks, and then over a period of 3 to 6 months, we added small cap banks and some PSU banks as well. That is now, as we speak, bearing fruits in the form of you've seen the financials performance come by, and certainly helping us as we speak overall. That will be one of our biggest overweights across our portfolios, if you were to look at it that way.
Okay. You continue to maintain that positive stance even now, because, for example, in PSU banks have had I think a 40% rally in the last 2 months. Do you still believe there is juice left? I mean,
So this is where, yeah. So this is where your comment earlier that off late there has been a bit of moderation comes in, where now that we have seen a good bit of rally, particularly in high beta, so-called lower quality names, rather than bucketing into one way or the other by lineage, we have now gradually started consolidating towards higher quality, which can sustain the growth rates, are still reasonable in valuations, and where the long-term story on growth or medium-term story on growth is still intact. Some of the PSU banks where clearly a valuation catch-up place, and clearly, I mean, there is some more room to go, but a good bit of that has already happened.
Interesting. One final question, Trideep, on this. At the small cap end as well, I think those numbers haven't gone down a bit. So my question is, do you still find favor in some of the smaller, maybe private sector banks? And couple that up with a view on the non-banking financials as well. What's your opinion there?
Yeah. So I think one of the things that I'll take the second question first. One
Sure.
of the things that we did as a nuanced view within that of financials was, particularly in the first half of the year, we went significantly overweight lending financials. So NBFC is a very broader, broad basket. It has insurance, it has AMCs, and a whole bunch of other stuff. But basically, we figured out that overall, if the economy is picking up, then lending has to pick up. If lending has to pick up and adjusted for valuations, then the lending financials is the place to be. And that is where we went significant overweight on lending financials part of the portfolio, mostly banks, but some NBFCs too. Small cap space, we find a little bit of a challenge, particularly finding good financials, particularly lending as well as non-fin lending financials. That's why our positions there are a little more concentrated than we would like it to be. But nevertheless, to answer your question, we went significantly overweight the lending part of the financials more than the broader basket. What was the other question you asked?
That the NBFC space in the small cap end, because the holding has stayed intact or maybe just gone up as well, consistently, you found smaller pockets on the NBFC side as well?
Yeah. So there, I think overall couple of non-lending financials is where we got into, so to diversify, and that is why while the holding looks up, the exposure to particularly in the PSU side has probably come down a little bit. So we balance that with a little bit of a non-lending part of financials, maybe AMCs, this, that, the other, which made life, which could be kind of bottoming out, this, that, the other. So a bit of diversification. Financials is a big sector now,
That's true.
whichever way you cut it, and hence there are now options to allocate money between various pockets or sub pockets of financials as well. So we moved around from lending financials after having made good bit of money a bit into non-lending financials of late.
There's churn seen in your portfolios on tech as well. It's consistently come off all through the curve. Even, I mean, I reckon compared to what it may have been in September, it is lower than that even now. So you were right on the button, I reckon, in getting out. The question is, do you still believe that you might want to stay or go down further this curve on the tech side, or is there merit in trying to now look at it from a buying perspective?
So I think I remember anecdotally the data point when one of our service providers called me and said that some of the tech companies on the mid cap side should be compared with consumer companies. Uh, this is around about September, October last year, and that struck me as an alarm bell. And that's when we actually kind of went meaningfully underweight, particularly mid cap IT, and to a certain extent a large cap IT as well. Our underweight probably peaked round about August, September, that time frame. We would incrementally not go further underweight. Um, we think that at some point over the next 6 months would be a good time to sort of allocate incremental money towards IT. But gradually and slowly, because the main issue of contention, as I'm sure you know, is basically the FY24 growth rates and the impact on so many different macro variables that we are seeing right now. The first glimpse of that will only be available to anybody and everybody round about January or the first quarter of next calendar year. That's when the IT budgets gets frozen. That's when companies would know, analysts would know, and everybody would kind of understand that what kind of impact can or has these layoffs that we are seeing in the Western world has had on IT budgets. Before that, it is more a question of speculation. Once we kind of right gauged that impact, that will be the right time to probably go add incremental money towards IT. So I think I don't have a clear answer when.
Yes,
Broadly speaking, I know probably in the first 6 months of next year, but it is subject to how the data points evolve, and I've given the framework of evaluation.
yes, most certainly. I reckon, Trideep, embedded in the answer is the point that the valuation comfort is probably there. You just need
Right.
the data points to kind of fit into your theory.
Correct. And basically the earnings estimates to bottom out.
Earnings estimates to bottom out as well. Great. Thanks for that. The other churn that we saw, or at least the other churn that when we were looking at your portfolios, we saw construction coming off quite significantly from whatever, not that it was a very large exposure, but from whatever it was, it's maybe more than halved or something like that, or even more. And again, across the spectrum of market caps. Tell
Yeah.
us a bit about this.
Yeah. So that is one half of the story. Basically, if you look at industrials, capital goods, construction all in one canvas, then what we did was around about a year or so ago, we moved out of construction to a certain extent and allocated that money towards industrial stroke capital goods, which are more manufacturers rather than EPC players. The thinking behind that is that from a future growth, as I said, that one of our other big overweights in our portfolios is basically industrial stroke capital goods. And the drivers of growth this time around would be more the manufacturers, because that is the areas where capex would be spent would be in like new energy, data centers, this that the other, and a better way to play that would be the manufacturers. And hence we allocated money out of construction into or EPC players, more into industrial stroke capital goods players, some of them being MNC, some of them being local. We again reaped significant amount of benefits. I mean, some of these stocks have turned out to be two-bagger or three-bagger over this time frame of this switch that we made. But that again is a good spot. But one half of the story, we allocated significantly more to the industrials and capital goods.
Okay. Thank you for correcting me. That escaped my attention. So thank you for putting that into perspective today. In your opening answer, you spoke about a pocket which has found a lot of favor of late, and that is defense. It's a real sector. There's some 15, 20 companies. Order books are bulging. The possible order inflow over the next, whatever, 1-2 years seems significantly higher than the combined execution capabilities of all of the companies. Tell us, how are you looking at it? Because the sector has seen some run up already. Is this the start of a multi-year run, Trideep, or you wouldn't go that far?
No, I would go actually further than that. No, not multi-year. It is probably a 10-year opportunity overall with regards to where India's ambitions are. We have to sort of take a dipstick every few years to check if the steps taken by the government are in the same direction or not. But as long as they are, what we are looking to do in the form of indigenization of defense is probably a 10-year opportunity and not just next 2 to 3 years. And in that context, I would say the capability of the companies, the kind of companies that we are looking at, or the ecosystem is not yet fully developed. So
Yeah.
my answer would be watch this space. Lot many companies will probably either go IPO or will join this bandwagon overall. At the moment, we have fairly limited opportunities in the limited listed space that we can play with, and we certainly have taken a meaningful exposure through all of our portfolios wherever we can to this theme. But we would see this as a multiple year or decadal opportunity rather than just a multi-year opportunity.
Mm. And would it be across buckets, Trideep? Because I mean, there's this shipyard companies, arms and ammo companies, so on and so forth, and some very specialized companies with some, I mean, very unique capabilities that have now come to the fore. Is you like the entire spectrum, or are there specific pockets that you may like, and why so?
So while I can't get clearly stock specific, but
Of course.
the investing framework to use is uh, uh, like in every sector, there are obviously everybody will have their day in the sun. But what is most important from a minority shareholder perspective is that same opportunity gets captured with better profitability along with higher growth and higher return ratios. So within the companies which are exposed to the defense theme, I would probably be more positive upon those companies which can maintain the profitability despite government being the customer, and hence the service offering is a little more specialized. They have a decent amount of pricing power in the way they go about their marketing their offering. So they are in the niche rather than making a commodity offering. And I suppose they are in the on the right side of the order book, which means they have a good amount of order book which covers next 2 to 3 years. So as long as those two or three ticks are there, I would probably be bullish on those names over a multi-year time frame.
Just one quick follow-up, Trideep. As a lay person, maybe I'll bucket defense companies into one bucket, which is the PSU majors, arguably having a mode of entry, what have you, to a set of companies for which defense is a part of their ops and not the entire ops. And then three, a bunch of private sector players, which are second run by virtue of the size that they have. They are not necessarily the largest. Now, without, again, I do not want you to comment on specific stocks at all. I'm just trying to understand, have you found opportunities across each of these, or are you more sanguine about A versus B versus C?
So I think it's a fairly long question in the sense the answer is could be fairly long, but I would summarize something like this:
Sure.
that we at the moment have clearly a shortage of choice. All the buckets that you sort of talked about are not yet there, which is why I said that over the next 3, 4, 5 years, you might see more IPOs come in there, and we will sort of evaluate as they come along. But the best place that I would like to be are those companies which can be capitalized in the way they go about doing the business. So one way is to bucket as per what you are saying, which is PSUs is that the other. But other way to think about it is some companies may need to invest significant amount of money building the capacity ahead of time before the revenues come in. While that might be one way of going about it, there could be others who can get built along the way. The guys who get built along the way are usually the most profitable investments purely from an
Mm,
investment standpoint. Both the areas would see benefits, but from profitability standpoint, the second category is a lot more interesting. So I would use that sort of a framework, a capital light sort of a framework, to play this theme as much as possible.
interesting. My final question, Pradeep, is on sectors or themes which have had a slightly tumultuous 2022. Whether they did well in 2021 or no is a separate case in point. But pharmaceuticals, for example, biting the dust, so to say. Specialty chemicals, from what they were, not quite there. I would reckon your allocations too might have changed there. What's your, I mean, so what has been the change, if you will, and what's your sense about what could 2023 bring in store for them?
So I think those are the areas which have been the sources of capital from our portfolio standpoint over the last year, and they have funded the capital which has gone into financials, capital goods, direct and indirect plays on real estate, and what have you. And there is nothing fundamentally wrong with these two sectors that you mentioned, particularly pharma and chemicals, except that overall they've had a fairly good previous couple of years, and hence the earnings are just about catching up with regards to, we call it over earning or sort of under earning. They over earned for a couple of years and now they are coming back to normal. So in terms of all the sectors that you mentioned, you probably kind of didn't include IT in there, but I would say that of all the fund areas that funded capital, pharma, chemicals, IT could be an interesting place to be from a next year standpoint. The other two would be very stock specific, and company specific teams take precedence over sectoral calls, is what I would say.
Got it. This was really insightful. Thank you so much for spending the time and talking to us. I know this is not a complete conversation, but that would take a really long time. We understand you have paucity of time. So thank you so much for joining us and giving us some insights into how you've thought about the churn in your portfolios.
Thanks, Neeraj, for having me on your show as always.
No,
Happy
it was
investing.
us. And viewers, thanks for tuning into this very insightful episode of BQ Conversations.